and you would have $100,000 annually in dividend income if you go through those steps. Hey, what's going on YouTube? So today we're gonna be talking about dividend investing. We're gonna be taking a look at how much maybe we need to have in our portfolio to be able to get paid out in dividends in the next 10 years and take a look at and see how the portfolio actually did. So we're over here on the screen now. You can kind of follow along here and see we have my portfolio in M1 Finance, nicely named Dividend Dentist. Although for those that are new here, yes, I do have stocks in this portfolio that don't pay out dividends as of right now, but either they will in the future or I'll sell them for a nice gain and put them into dividend paying stocks. So you can see our current value on this portfolio is sitting at $45,198. I think this is now the highest that we've had on screen here on recording, which is really nice. You can see our total gains for everything that we've made is over $8,047, $446 of which has been dividends earned. If we take kind of a quick peek back over here, the last day was really nice. We were up 655. The week we're up about 416, so a little bit up and down this week. Over the last month, we're up $2,400, which is a great thing to talk about when it comes to making sure you keep on investing regardless of how the market's doing if you're in it for the long term. You can see also here over the last quarter, we're up $2,137, and in the year, we're up $7,481. So this is really awesome. I always like to kind of emphasize this too. I started this portfolio on January 23rd, 2019 with $100. So if you're somebody who's, kind of worried about getting started and sees, bigger portfolio amounts, just understand that getting started is the biggest key, and then staying consistent is the next thing. So open an account, get started, put $100 in. If you want to use the same account that I use, this is M1 Finance. I love using them. I do have a link for them in the show notes down below. You get a nice little sign up bonus, and it does also support the channel, so you get more free content like this. But the big thing is, again, you get started. So let's talk a little bit about getting, long-term dividends, because our goals and everything are all going to be different, right? So for my account here, the biggest goal for this account is to kind of build up both on the sides of dividend investing, but also a little bit of growth. So you can see I have a growth slice over here. And this slice right over here, I have Google, Amazon, Tesla, and Facebook, all of which don't pay dividends, like I kind of mentioned earlier. I was looking at different companies, something like Facebook as an example. I'm going to jump over here to Seeking Alpha. And what we're going to do is just take a quick look here. So you can see that their earnings per share is about $13.10, which is pretty fantastic. So if we go to the dividend tab over here, this gives you a hypothetical projection. If they did decide to start paying out dividends, a lot of people look at these companies and say, they're not going to pay out dividends. Well, Apple didn't pay out dividends for a good chunk of the 2000s, and then they started paying out, I think, in 2012. So, imagine if you were, buying shares of Apple before they started paying out dividends. Your yield on cost might be really, really nice. So you can see right over here, these are just hypotheticals. So with a $13.10 earnings per share, if they paid out with 10% of their earnings per share, they would pay out an annual dividend of $1.31, which is 0.37 yield, which is obviously a very low yield. But if you look at the very high end, so if you go to the 60% payout ratio, which I just covered up, 60% right over here, which is kind of industry standards, like a lot of companies try to stay within 60%. That would be an annual dividend of $7.86. Did I say dollar amount up here? Hopefully I did, but $7.86 right over here, which would actually give you a yield of 2.24%, which is still not the golden number of 4% that a lot of dividend investors talk about. But one of two things. One, if they continue to increase their dividend yield because maybe their earnings keep going up, then that's a really, really great thing to do. A lot of bigger companies that pay small yields tend to have bigger increases year after year. So that's always really nice. I'll show you an example of that. And then you can see over here, this is as of right now. So if they still don't pay out dividends for the next 5 years and they keep growing, but you're buying in at this price point today and their stock price keeps moving forward, your yield on cost will effectively be much better than somebody buying the day that they announce the dividends. So if they do, obviously it's all hypotheticals, but let me go with an example here with Apple. So Apple's a very popular stock. You could see here that their dividend yield is, very low. It's 0.61% yield, so very, very low yield. That gives you 88 cents per stock, which is pretty small. But their payout ratio is really, really low, which means that they have a lot of room to continue to increase their dividend. And you can see here over the last 5 years, on average, they have grown 9.41% yield, 9.41% over the last year. So that's a pretty big increase. And I'll give you some examples here. I think the last year hasn't been as much, but obviously with everything going on, I think maybe they were being a bit more conservative on that end. So you can see this one was the last increase that they did. It said Apple raises their dividend by 7%, so lower than their 5-year, but still. So right here you can see they raised their prior dividend from 0.205 cents to 22 cents, which doesn't seem like a lot, but if you hold thousands of shares of Apple, that's a huge increase. That's a 7% increase right there for having done nothing more but already own the stock. And other companies do this even in bigger numbers too sometimes. So I think one of the last ones that I've had recently, I'm trying to think of which one it was, recently increased their dividend by a healthy margin. Maybe it was Lockheed Martin. Let's go ahead and double check this one. See if this was the one that did it. Well, they did a 8.5% increase, which is still really good. Actually, I think I know what it was. I think it was Texas Instrument right over here that I have in my portfolio. So if we go to news and we go to dividend news, so right over here, this was late last year, so hopefully this September they'll actually do it again. But you can see they actually increased their dividend by 13%. So they were paying 90 cents a dividend, and then they jumped it up to $1.02 a share. That they paid out. So that's a huge increase. That's a 12-cent increase, which again, just 12 cents is not a lot, but if you own hundreds, even maybe thousands of shares of one company, that increase right there is a huge boost to you. So just imagine at your job getting a 13% increase. I think you'd be pretty happy about that as well too. So just something to consider when kind of going over these. Obviously, we talked about, with like Facebook and Tesla and Amazon and Google, if worst case scenario, when I do want this money for focused purely on having dividends and living off of them, or, doing whatever I want with them, I might end up selling these companies and using the proceeds that come from this to be able to buy into stocks that are paying like a 4% dividend, like Realty Income or something like that. Because Realty Income is great. They just don't increase their dividends as much as some of these other companies that we are looking at here today. So one of the things that I like to also kind of go over as well too is understanding that, for me, the dividend yield today is not that important, because if we go to my portfolio over here, so this is with Track Your Dividend. So what they do is actually show you the current yield. If you bought into my portfolio, like if you took what I have right now and bought into it, you would get a 1.07% yield, which is really low. My yield on cost is actually 1.26%, because some of the companies I have increased their dividends, like Texas Instrument, Lockheed Martin, Apple. All these companies have increased their dividends, which means that I'm actually making more having not needed to buy more of these companies, or more shares of these companies. So you can see if I kind of toggle over here, some of these companies, some of them are bigger than others, like Discover Financials. I bought them at one of their lowest points over here. So their current yield, if you bought into them, is 1.44%. My yield is actually 3.14% because of how much I've paid for each share of the company. Now, I don't have a lot of shares. You can see I only own right under 10 shares of the company. Obviously, if I'd known better, I would have bought a ton more at that lower price point and gotten that great dividend yield. But nonetheless, it is how it plays out. So I'm not sad about that. But even other companies like Home Depot right here, I own almost 10 shares of this one as well too. Actually, I think I own 10 shares now. This is just not updated yet. But you can see here, their current yield is 2.05, but my yield is actually 2.29%. Again, I'm just showing these things because it helps kind of get an idea of investing for the long term and how that can impact you. So when we go to these calculators and we talk about this stuff, you can see how having a low yield now doesn't necessarily mean you're not going to have a good yield down the road. So let's kind of go ahead and plug in some information with this dividend calculator. So our current amount is about 45,200. We're just going to go with that. So 45,200. And then what we're going to do is toss in our annual dividend yield, which right now we talked about is technically 1.26%. So 1.26%. Then it's going to ask us if it's in a taxable account. For this one, it is. And then it's going to ask us for our annual contribution. So we're just going to start off with the basics here. We're going to do $1,000 a month in this portfolio to see how this impacts everything. And then we can change these numbers as we go along here. So this part right here, it says expected annual dividend increase percentage. So this is how often are these companies increasing their dividends. Now, we talked about how something like a company like Texas Instrument is increasing by 13%. Apple did 7% most recently. Lockheed Martin did like 8.5% or so. So all these companies are obviously increasing at different rates. So some of them are going to be higher, some of them are going to be lower. A lot of the ones we have in this portfolio here with this is going to be a little bit on the higher end side because we are focused with lower dividend yield today for higher growth tomorrow. So with this example, we're just going to go ahead and put in, let's just say 7% for this example here today. Then it's going to ask us distribution frequency. We're going to go ahead and do monthly because actually no, we're going to do quarterly because a lot of these companies are paying out on a quarterly basis. Obviously, they pay out on different months, but we're just going to go with this example. And then our dividend tax rate, we're just going to put that back at 15. And then expected annual share price percentage appreciation. So this is, how often it's going to be going up. Our hope is, 8 to 12%. We're just going to do 10% for this example here. And then DRIP stands for Dividend Reinvestment Program. So this is investing your dividends that you've earned back into the portfolio that they paid. And then we're going to do years invested. For now, we're just going to do 10 years. I want to see how impactful it could be in 10 years going with this portfolio with $12,000 invested annually. So let's go ahead and hit calculator. We're going to have some notifications pop up here from this website. And then we're going to see right over here. So after 10 years, there's the thing. So after 10 years, this portfolio is potentially going to have about $341,000 sitting in this account. You can see here our annual dividends would be about $8,534. And then our yield on cost would be about 5.17%, which is obviously higher than the 4% that people talk about because we are investing now and having the growth come over time, which will bring us to that higher yield. Now, $8,500 a year annually is not a lot, obviously. For most people, the big goal is to try to get to $1,000 a month. So this right over here, what would this equal out to exactly? This would equal out to $711.16. Nothing to, scuff about because, hey, that's still money coming in every month for having not to do pretty much anything. But, let's say in 10 years we do want to hit $1,000 a month. So how do we do that? Obviously, increasing the actual annual contributions would be a big thing. Maybe going with companies that are paying increased dividend yields now, so we can increase our annual yield. So maybe going with companies like Realty Income that pay 4% today. Because, for some people, the way they kind of look at it is, hey, I'll get the 4% today, but I'll reinvest it and then have that money working for me now versus, getting the money later. So there's pros and cons to each one of these options as well. So let's just go ahead and say that we actually decide to bump this up to, let's say, $16,000 a year. So we, break that down, per month. It makes it a lot easier to manage on that. So let's go ahead and see how this ends up looking out for us. So we're definitely getting closer. You can see over here, $400,000 is what we're looking at for our principal here. And for our total, I should say. And then right over here, our annual dividends, $10,260 is what we're looking at for our annual dividend income. So close, but not close enough because obviously if we're wanting to get that $1,000 a month, we need $12,000 annually. So from this portfolio, let's see if we do 18,000, what this comes out to. Because remember, a big factor into this is how much we currently have in the portfolio. So if you're starting at zero, obviously in 10 years, you would probably have to be putting in more to catch up because the really interesting thing with investing is the sooner you get started. So if you get started today, the better you're going to be off long term and the less you're going to have to worry about. But if you wait another year, another 2 years to get started after watching this video, then that's just going to be more money you have to put in to be able to even get close to it. Even if you start off with a little bit. I showed you here with this portfolio right over here, I put in $100 to get started with. Once I got more comfortable, understood kind of the direction I wanted to go with my portfolio, that's when I started putting in more. You can see the value changing over there a little bit more over time, and then I got more comfortable. I was doing $10 a week at the most because I wanted to kind of get an understanding of how this portfolio was going to flow. Like I mentioned earlier, check the link in the show notes down below to start an M1 Finance dividend portfolio just like this one, so that way you can actually get started. I'll have a tutorial link down there too, so if you want to use this account style but want to make sure you set everything up properly, I'll have that for you too, so just make sure you guys check those links out below. Like I said, they do support the channel, but you get all the free content just like this. So back here, $18,000. What does this bring us out to? A little bit closer. We're at 11,000 right over there. So let's kind of change this up again. Let's do 20,000 right over here. So a little under $2,000 a month that we'd had to put in. And right there, we pretty much get what we needed, which was getting $12,000 annually, which is $1,000 a month. Now, this is only for the next 10 years. Obviously, if you don't need the money in 10 years, you can keep reinvesting it, and it gets even crazier. So I wish I can like cap how much you contribute and then just keep going. But let's just say you keep doing the same style here for the next 15 years. So 5 additional years. This is just 5 extra years in this portfolio. Check this out. Boom. You jump up all the way to almost $35,000 annually in dividends in just an additional 5 years. And look at this. Your ending balance portfolio will be so close to $1 million, if not already surpassed it, in just 5 years. Let me show you what another 5 years does to this portfolio. This is where it gets really crazy. This is how impactful it is to get started sooner rather than later. Again, just another 5 years doing everything the same. Nothing changes, right? Everything else stays the same, stays constant. You would get over almost $2 million. And again, just another 5 years. So you would actually almost be doubling your money in 5 years, which is a really good ratio right there. And you would have $100,000 annually in dividend income if you go through those steps, plugging in those numbers and seeing how that money just keeps growing and having an impact towards your financial future. Can you imagine $100,000 every single year coming in for just doing nothing else but, owning these stocks and these companies and these funds that are providing this for you? $100,000. I would not be sad about that. What would that come out to per month on average? Because obviously a lot of these companies that I have in my portfolio are paying out on a quarterly basis, but on a monthly basis, averaged out to $8,243 in 20 years. So that's a really cool number. I want to keep working towards that. Maybe we're going to hit that goal here on this channel, showing you how that is possible just by going through the process of learning and growing and being more educated, which is what I want you to do. So I want you to click this next video here on screen so you can keep on learning and growing and building up your dividend investing portfolio. My name is Dennis, and I'll see you in that next video.